Intermediate traders often fall into a trap. They want to be sure before entering a trade, so they start stacking tool after tool on their screen, hoping the extra beta will guarantee a win. A typical setup looks something like this: a relative strength index, followed by a stochastic oscillator, and then maybe a MACD tacked onto the bottom for good measure. The problem lies in the math. These three specific tools belong to a category called momentum oscillators. They measure the speed of price changes over time, and if we break down their underlying formulas, they all rely on the exact same raw historical price data to generate a signal. You aren't getting three independent sources confirming a trade. You're getting one signal repeated 3 times. When the market moves, the peaks and valleys on these graphs move in lockstep. When those deeply similar tools inevitably print slight, confusing disagreements, maybe the RSI dips into oversold territory a fraction of a second before the stochastic does, you freeze. You wait for perfect alignment, and the trade passes you by. A cluttered screen like that creates an echo chamber. It feeds you duplicate information that masquerades as certainty, causing you to hesitate and miss actual market moves. To fix this, you have to stop acting like a data collector and start thinking like a systems engineer. A functional trading strategy is a machine, and every indicator needs a specific, independent job. We can group trading tools into distinct families based on their function. First, we have trend indicators, which measure the overall sustained direction of the market. Next is momentum, which tracks the velocity, the literal speed of those price changes. Then there is volatility, which measures the pure magnitude of price swings, regardless of which way the market is moving. And support and resistance tools, which identify the invisible ceilings and floors where buying or selling pressure typically clusters. Finally, we have volume. This tracks the actual amount of trading activity. A price spike matters a lot more if a surge of market participation backs it up. With these categories defined, we can apply the one of each rule. To build a lean, effective system, you select a maximum of one indicator from each necessary functional category. By enforcing a strict limit on your components, you guarantee that each tool does its own distinct work. Your momentum gauge covers the blind spots of your trend line, cutting out the mathematical overlap. Let's assemble a non-redundant trend-following system from scratch. This interface shows raw price action, and we are going to apply a classic trio of tools to decode it. Component 1 is a 50-period exponential moving average, our trend tool. It averages out recent price data to give us a clear medium-term direction. If the current price sits above this line, we strictly look to buy. Component 2 is the relative strength index, covering our momentum family. We use this to pinpoint timing. We want to identify the exact moment an upward trend experiences a temporary pullback, indicated by a dip into the lower, oversold section of the index. Component 3 is the average true range, representing volatility. This tool calculates the normal market noise over recent periods, giving us a hard mathematical value to place a protective stop loss far enough below our entry to avoid getting randomly kicked out of the trade. When we put the sequence together, it flows logically. The trend line permits the position, the RSI pinpoints the precise entry, and ATR dictates the exact risk. Direction, timing, and risk management are all processed seamlessly. You have 3 distinct variables working in harmony without a single overlapping mathematical data point. A purposefully engineered 3-part setup like this provides a clear, actionable view of the market, cutting through the noise of a dozen competing, redundant indicators. However, every piece of indicator math processes data from the past. The raw, undeniable truth of what the market is doing right now is found in the price action itself. If your carefully chosen momentum tools signal a strong buy, but the raw candlesticks are visibly carving out a series of lower lows, the price is telling you the truth. You trust the immediate market reality over the lagging calculation. You can apply that same focus on clarity to your timeframes. Multi-timeframe analysis allows you to confirm a trend simply by zooming out. Instead of dragging another trend line onto your 1-hour chart, you reference the cleaner, dominant trend on the 4-hour chart. Once your non-redundant system is assembled, it requires rigorous validation. You have to backtest your integrated edge against historical data. A common error is testing one indicator in isolation, seeing a low win rate and discarding it. A moving average and an RSI might both perform poorly on their own. The true edge is found by testing the exact intersection where all your strict system rules align at the same time. True execution relies on radical clarity, not the volume of data on your screen. Strip your charts down. Apply the one of each framework to select components that actually complement one another, and run that specific system through a backtesting platform to validate your edge.